Welcome back to the Wall Street Podcast. Today we're digging into a recent report from Citi Research. It's titled AI and a Structural Case for the S&P 500, and it just came out August 1st, 2025. What they're doing is looking at the S&P 500 and asking, is this current state an AI bubble, or is it maybe a more structural bull market? Citi seems to lean towards the latter, but with some caveats.
Right. They dissect the index pretty neatly, actually. They categorize stocks into AI-related, then non-AI tech, and finally just other. This gives them a way to look closely at performance, valuation, and, importantly, the productivity side of things. The goal really is to build a more structural case for U.S. large caps based on what's happening right now.
Okay, let's get into that first part, the concentration. Citi found nearly half, almost 50%, of the S&P 500's market cap is now classified as AI-related. And that's just 84 stocks.
Only 84. Then you've got about 25% in non-AI tech, and the last 25% is the other category, which is 269 different stocks.
And when Citi says AI-related, what do they mean exactly?
They're focusing on firms directly tied to AI infrastructure. Think chip makers, the big cloud providers, core AI software companies, the enablers, basically.
Right. And this concentration, it's significant. These AI stocks have obviously outperformed massively since late 2022. Their PE ratios look high by historical standards. But the report points something else out about valuation.
Yes, exactly. While the traditional PE percentiles are high, Citi highlights that these AI-related stocks actually trade at a lower PEG ratio, looking at near-term estimates. So just to remind everyone, the PEG ratio adjusts that PE for expected earnings growth. A lower PEG, well, it implies the growth expectations are stronger and perhaps more justified. And this seems supported by earnings revisions trends, which look better for this AI group compared to the others.
So given those high PE multiples we see, how does Citi actually justify them? Is it just the growth story?
Well, it's more nuanced. The report argues that, yes, the PE ratios are up there, but that lower PEG ratio suggests it's not just froth. It indicates the valuations are underpinned by really strong expected earnings growth and those positive revisions we mentioned. It signals investor confidence in the fundamentals, not just speculation.
Okay, interesting. Now, beyond just valuation, Citi introduced a metric called the EPS Sharpe Ratio. What exactly is that measuring?
It's a neat concept. It measures the annualized earnings per share growth, so how fast earnings are growing against the standard deviation or the volatility of that growth. Basically, growth consistency.
And what did that show for the AI stocks?
A big difference. The AI-related stocks showed an EPS Sharpe ratio of 0.74. Compare that to 0.38 for non-AI tech and just 0.27 for the rest of the index. So what that tells you is that the AI group isn't just growing faster. Their earnings growth is also much more persistent, much less volatile. It reinforces that idea of growth as defensive.
Growth as defensive, right.
And it doesn't stop there. These same companies, the AI-related ones, also show better operating leverage, more consistent gross margin improvements, and stronger trends in sales per employee and return on equity over the last decade.
So if we were to boil down the key takeaways on operational efficiency for these AI companies, what would they be?
The data really points consistently in one direction. Companies tied closely to AI just demonstrate better operating efficiency and leverage. You see it in those persistent margin gains, higher sales per employee, rising ROE. It all translates into more durable earnings. It suggests the efficiency gains are real and structural within these firms.
All right, so putting this all together, the concentration, the valuation justification, the earnings strengths, what does Citi see as the S&P 500's long-term path? What's the structural case?
They argue for a structural bull case, fundamentally. It's rooted in two things. First, the ongoing build-out of AI infrastructure, which benefits the enablers. And second, the sustained operating leverage these companies have shown. But the critical next step, the transition point, is when the broader market, the AI adopters, start incorporating this tech effectively. That's when you'd expect to see their earnings durability and productivity improve across the economic cycle. That's the key link.
Makes sense. But there must be risks. What's the main one Citi flags with this whole AI-driven dynamic?
The primary risk they identify is a timing mismatch, essentially. It's the possibility that this AI build-out phase matures, the infrastructure gets built, but then it proves difficult for the users, the adopters, to actually show concrete returns on that AI investment. If that adoption doesn't translate into broad productivity gains and clearer earnings improvements across more sectors, then you definitely run into a bubble risk. The investment needs to pay off more widely.
So it's clear from this deep dive that AI's impact on the S&P 500 is huge, but it needs that context, looking beyond just the standard metrics.
Absolutely. The structural endgame Citi envisions involves higher confidence and earnings persistence across the board, which should justify higher terminal values for the index eventually. But this is something that will play out over time. It gives us a different lens, for navigating the usual short-term and medium-term cycles. I suppose the big question hanging over all this for you, the investor, is how much of this potential structural shift is already reflected in today's prices.